G'day there, Wealth subscribers, viewers, traders, and investors. It's time for another Friday end of week wrap up with my friend and special guest, Roger Scott. Roger, welcome.
Thank you for having me on, James.
Of course. Roger, it was rather a spectacular week, and I don't think we could very credibly undertake a market wrap up without discussing what happened with Wall Street Bets and the Reddit crew and GameStop and AMC this week. It was rather a poignant lesson in who's in charge on Wall Street. Would you concur with that?
Yes, I completely do. As a matter of fact, these Wall Street these bandits, I call them bandits on Reddit. That's what I call them, bandits on Reddit. They really thought they were going to continue with these shenanigans. But what happened over the weekend, the SEC stepped in, obviously put a lot of heat on these brokerages. The brokerages curbed these stocks. And then to add insult to injury to all of them, they tried to pull this on silver. And if you recall, you and I brought that up. I said, doing this on GameStop is one thing, but doing this on an ETF that's tied into a global commodity, they're going to get a lesson in rude awakening. And that's exactly what happened. They tried, and it wasn't very successful, and they basically gave up. And that's aside from the fact that the government regulators are doing everything possible to make an example out of these people. So as a matter of fact, when this was happening, I brought up several stocks. And I brought up GameStop, SPCE, AMC, BBBY, LGND, and Fizz, and KOSS, iRobot, and EXPR. And all of these are substantially lower now. And I mean substantially lower. I had profit targets that were, one stock was at 85. I was telling people it was going to go to 3. Another stock was at 125. I was telling people it was going to go to 85. Another stock was at 4 or was at 6, and I was telling people it was going to go to 1. And believe it or not, some of them are not there yet, but they are well on their way.
Yeah, no doubt. It was intriguing to me that the GameStop Wall Street Bets crew said that they just like the stock. And so I dove into the GameStop financials. And, this is a business that's basically been disintermediated by the internet. Kids download their programs directly from the publishers of video games, and they order their consoles from the manufacturers through Amazon. So GameStop has no business. GameStop had no game. So for them to say, we just like the stock, was the epitome of BS. Nobody likes this stock. And so if you're going to try to squeeze some shorts into going long or covering their shorts, you better do it. At least start with a business where there's an argument, a rational argument in favor of a higher stock price. And because otherwise, it's impossible for any entity to improperly inflate a share price, because you have to cover if you're long, you have to cover if you're short. If you're just going to pump money in and hold this thing up, well, guess what? The market's going to crush you because you can't hold up the market. So, I had open warfare with the whole Wall Street Bets community over the last couple of days, because I told them that the essence of what they're doing was a colossal misappropriation of capital. And that, they had an opportunity to use their considerable clout and influence to put that into something that made sense. In other words, a business with a future. Anyways, I was basically accused of working for the hedge funds and, being a paid shill of the hedge funds. And it was like, no, you guys, it's not that you think you're Robinhood. You like to think you're Robinhood when really you're just hedge fund monster junior. Your behavior is exactly as atrocious and predatory as those of the hedge funds. And it's like you are completely delusional. So, good riddance, really, at the end of the day. It was an anomaly and a momentary flash in the pan. And I find that the mainstream media has even blown it out of proportion.
I couldn't agree with everything you've said more, completely. I just wanted to add a little wrinkle to when you started talking about it. You were talking about you started talking about how it would make sense to do this on a stock that actually has a story, a potential, not an obvious dying dinosaur. From what I understand, and this is just more of a adding context to the picture. From what I understand, the Reddit forum is a huge forum for gamers, James. Okay, and gamers. It's kind of like, what stock do we all know? If we do know about one stock, what is a GameStop? Because gamers, GameStop's been around for forever, as far as I'm concerned, at least 20 years. So the point is, the point is, I think that might have been one of the reasons why they picked GameStop to start this, because it was one of the few stocks they actually kind of like, hey, what company do we all know about? Oh, GameStop. Oh, yeah, right. We're all gamers. So I think that was part of the part. I think that had something to do with their logic or familiarity. But I think that's how it all got started. Gamers, GameStop. Anyways, because they did interviews with a few of these. I don't want to call them by the names that I've picked for them, but let's just say these degenerates, okay? And they look like they were big gamers. They really, like, how they had the monitors and they were no financial guys. These were gamers, hardcore gamers. So I think that might have had something. That's not here nor there, but I just thought it kind of added an interesting context to the story. But I don't think we're going to be seeing much more of this. I think the SEC is going to be contacting and doing a deep dive and making examples out of it, because in my opinion, and I've talked to you, I've talked to people who've been around the block more than a few times, and the people who really appreciate the market for what it is, nobody was happy about this. Nobody has time for cowboys in a real serious games.
Right. Yes. Well, it is interesting. People say the market's broken. The media, especially, is saying the market's broken. And for me, this was an example of how actually the market's not at all broken. The market functions as an extremely efficient, spotlight on imbalances in the market, whether it's clout influence, whether it's misallocation of capital, whether it's investors misguidedly trying to prop up a dying business. The market is the ultimate crucible of truth, because no matter what you try to do, corruption, anything, it is revealed in the crucible of the market, because the forces of supply and demand, of good and bad, evil, fear of missing out, greed, all these things are present there, and it strips away all your human ambition and leaves the sum total of the mixture of all these human influences. So I don't think it's broken. I think it's working perfectly. And yes, the SEC is going to come in and over-regulate it, but don't worry, the lobbyists are going to have those regulations rolled back in due course, and the market will continue to be the absolute melting pot, the inferno of unfairness and opportunity that it has always been. So let's move on. What were the outside of that debacle, which monopolized a lot of attention and liquidity? Where did you make money this week, Roger?
Well, to be honest with you, this was a very interesting week, because this is the week where the S&P gave us, this is the second big week of earnings. And when earnings are on the table, my advice to our readers, my strategy is to stay low, keep your head down, and not get hurt. I'm not one of those cowboys that bets on earnings plays. So my suggestion for guys has been the same. Also, keep something else in mind. It was easier to do that, actually, because the Dow Jones broke the 50-day moving average end of last week and beginning of this week. And I have a rule, and it's a real simple rule. What I notice is this, and this is something that your readers may find actually really interesting. Technically, you'll find if you put the S&P and or the NASDAQ, any index, and if you put the 50-day moving average, you will find that price action tends to gravitate towards the average when it hits it. In other words, it could stay near that period. It's almost like a magnet, you know, and it could stay near those periods and kind of go a little above and then hit it, go back down again. So what I like to do is I don't like to get involved in these false breakouts. I want the market to show its hand, because here's the thing. If the market continues and breaks the 50-day moving average and enters the area, which I like to call the twilight zone between the 50 and the 200-day moving average, that's a sideways market. That's a sideways market. That's a market you don't want to directionally trade. That's a market you want to capitalize with spreads. We haven't been in that market for quite some time. We've been in a very directional market for quite some time. So what I like to do is, and this is what I suggest everybody here does, when the market breaches a major index, price, major moving average, like a 50-day or a 200-day, give price action 2 days to completely trade above or below that index, the moving average, before you get back in. So in this case, after seeing late last week the Dow Jones breaking the 50-day line and the S&P following very, very closely behind, what we decided to do was, and what we always do is, we said, hey, if it continues down this route, we're gonna get out of a bunch of positions and change things. If it goes back up, we're gonna give it 2 days. Well, it just started that yesterday. It went back up. It broke again to the upside. Now we have complete 3-day clearance. Now I'm becoming bullish again. But so because of earnings, and this is a major part, last week, this week, and next week, James, are the meat, the prime window, if you will, of the earnings season. And taking that into account with this breach in the Dow Jones has made me very fearful over the past few days of the market.
It's not going to be the last time we see the rise of an influential group whose financial literacy might not be as impressive as its influence. And so what can we do to sort of in our minds to prepare for the advent of that again without getting caught up in it and without becoming victimized by it?
Well, here's the thing, and that's a really good question. I think the regulators are going to start making restrictions for stocks that have very low floats and restrict short borrowing and be more mindful of this happening and create circuit breakers and vet funds and individual traders when it comes to small cap stocks. I think that's what's going to be the major change. But in terms of the bigger picture, in terms of the broader, to get back to where you started the question, I don't think this is, if you look at this on a long-term basis, this is a blip on the screen. This is noise. Did it really influence? Let's be realistic here. Did it have any impact on the S&P 500? No. Did it really have an impact on the Russell 2000? Maybe, but probably not, since most of those stocks did not have a large capitalization in it. And if it did, maybe for a day or two. So yes, while it could have had a major impact on 10 small cap stocks, when you look at the market as a whole, when you look at the bond market, when you look at the gold market, when you look at the silver market, when you look at the currency market, when you look at the overall stock market, when 2021 comes to an end, this is going to be if we're lucky, a little blip, a paragraph in a financial magazine. So I don't think ultimately, aside from the regulatory impact, which we will not forget for many years to come, that I could guarantee you. But in terms of the type of influence it had on the market, I would argue with you. I would argue and say that the Fed inadvertently 30 times over the last 20 years has influenced the market a lot more just by the words they use. I mean, do you remember Greenspan with his exuberance, irrational exuberance? Oh boy. If we were to go back in time, in hindsight, obviously it's 2020, he would probably not use these terms. And I would probably bet you a couple of dollars that, or at least a dinner, that they had talks about that afterwards. So I think in terms of overall influence on the market, overall market capitalization, I don't think this did anything. I think this, if anything, James, if you want me to be really honest with you, I think this created an attraction to the market from people that were not interested otherwise. Honestly, I think if anything, that's all that happened, because I saw during that period of time, so many more people were asking comments on our YouTube channels, and volume went up. I think if anything, it intrigued people, but I don't think it had major impact on capitalization or anything. And quite honestly, anyone looking at a daily chart over time, aside from those individual stocks, would not even see it happening. So, and keep in mind, anyone looking at stock market over time always looks at it from a historic perspective. I look at things 20, 30 years. So this little blip, not really anything significant. We've seen a lot worse, a lot worse.
Yeah, you bet. You know, the one visualization of the effect was the spike in the VIX that occurred. It went from a sort of a baseline in the last little while of 23, 24, spiked up to 38 during the height of the sort of the GameStop confusion. But other than that, yeah, I agree. Obviously, there was no long-lasting effect on the markets. In fact, even the price of silver started to rally again, because it was rallying on fundamental reasons, not for GameStop reasons, before GameStop came along. But yeah, so that's great, a great lesson in hindsight, and I think that I think that it's good that it's over, because now we can just get back to the business of focusing on making money safely in the marketplace.
Right.
Are there any other sort of parting words of sort of advice that you would give to our audience before, you know, we part with this 1 week in retrospect?
Yeah, just a couple of really quick things. So we're about halfway done with earnings right now, and I wanted to give a good picture of what we're seeing. I just wanted to list the sectors where we're seeing some really good surprises. And folks at home may want to write this down because this is important. Tech is just killing everything out of the water. Tech earnings are, now keep in mind, estimates have been beaten down, but the numbers have been amazing. So tech has been doing really well. Auto sales have been killing it. Medical's doing really well. Basic materials doing well, and retail. So you got construction, autos, medical, basic material, medical, and retail, and technology. Those are the standout sectors so far. So far, we're only about 50% done. And last but not least, if anybody is interested in these short squeeze stocks, please just stay away or buy a put. Don't get yourself into an actual stock like a short or an actual asset, because if they freeze the stock, they're going to freeze a portion of your equity. So don't do that. Be careful. And probably the best thing to do is stay away from it. But earnings are substantially better than expected. And I'm very, very interested in the following sectors: construction, autos, medical, basic materials, medical, and retail. And that's it, James.
All right, Roger. Well, that's a great update again, and I really appreciate your time. I look forward to speaking to you next week. Have a fantastic weekend.
Thanks for having me on. Take care.